For those on the webcast, you'll find a copy of our presentation slides on our website along with our announced 2020 budget. Our very first investor open house was held around this time in 2001. Pretty much all the presenters you'll see today were at that first open house, and at least 4 of our current live participants, attendees here in the room, were actually at that investor house as well. Thanks Greg, Randy, Phil, and Bruce for continuing to come every year. Must be the bacon. Anyway, things have certainly changed both in industry and in Canadian Natural. Over that period, we've evolved into a very strong and sustainable energy company with very significant free cash flow. Since that first open house in late 2001, our stock price has increased tenfold, production has increased threefold, and cash flow more than fivefold. Finally, over that same time frame, we've returned about $15 billion to shareholders in the form of dividends, buybacks, and distributions. Put that in context, those cash returns equate to about 4 times the market cap during that investor open house in that year. We've shown we're very capable of delivering value to shareholders through various types of commodity cycles and business cycles. And this morning, the team will show you how we can continue to deliver today and well into the future. First, Tim McKay, our president, will provide an overview of the company and our strategy in these turbulent times. Following him, Darren Fichter, our Chief Operating Officer for Conventional and Unconventional, will provide a deeper dive into our natural gas, light, and heavy oil operations. Then Scott Stouth, our Chief Operating Officer for Oil Sands, Thermal, and Mining, will provide an operational and project update for these world-class assets. Then, following a short break, Mark Stainthorpe, our Chief Financial Officer, will provide an update on our marketing outlook, as well as our strong financial position and 2020 budget. Following this, Steve Laut, our Vice Chairman, will provide an overview of long-term sustainability, including elements of technology and ESG performance. Tim will then provide a short wrap-up just before the closure of the webcast. Presenters will then be joined by our Chairman, Murray Edwards, for a senior management Q&A where we'll take some questions from the floor. As always, I'd like to remind you about our forward-looking statements and our reporting disclosures. Of note, our reporting disclosures that everything is in Canadian dollars unless otherwise stated. As well, we report our reserves and production before royalties. I'd also suggest you review our comments on non-GAAP disclosures. With that, I'll turn it over to Tim.
Hey, Corey. Good morning, everyone. Canadian Natural has a proven, effective strategy. And as a result, Canadian Natural is in a strong, equitable position. We're delivering in today's environment, and we will continue into the future. This morning, we'll highlight Canadian Natural's industry-leading free cash flow generation and how Canadian Natural takes a disciplined approach to optimizing our cash flow to maximize value of our assets. We have a history of capital discipline, operational excellence, and we have a robust, economic, long-life, low-decline assets. And relative to most of our peers, the ability to enhance our margins, grow production, and with increased market access, results in long-term value for our shareholders. The key message you'll hear today is we're delivering free cash flow and ensuring a sustainable growing dividend, and with our free cash flow allocation policy, giving both more returns to our shareholders, strengthening our balance sheet. All of this, which is safe and robust in a volatile commodity price environment. Let's talk how Canadian Natural delivers. Canadian Natural's ability to deliver free cash flow today starts with our large, long-life, low-decline asset base, which has low maintenance capital requirements and is sustainable, allowing us to withstand commodity price changes. This is driven by our effective, efficient operations, our area knowledge, ownership and operatorship of infrastructure, as well as responsible operations. As you will see later this morning from both Darren and Scott, a culture of leveraging technology, innovation, driving continuous improvement throughout the company gives us ever-improving operations, environmental performance, and socially responsible operations. We have a defined growth value enhancement plan for every product and basin we are in. Canadian Natural's strategy includes flexible and effective capital allocation and our ability to be nimble to capture opportunities. Our strategy is simply to optimize capital allocation to maximize value for our shareholders while ensuring we are maintaining a strong balance sheet. Opportunistic acquisitions have always been a part of our strategy. However, we have no gaps in our portfolio, and the acquisitions need to make sense and add long-term value. It is for these reasons Canadian Natural has a leading free cash flow from, and we are unique, sustainable, and robust. Canadian Natural has a balanced, diverse product mix with approximately 48% light crude oil, SCO, NGO on a BOE basis, limiting our exposure to one product. Of our liquids, production 77% is from our long-life, low-decline assets, which is sustainable through volatile pricing as they require less maintenance capital. Canadian Natural has a long history of capital discipline. We accomplish this by strategically allocating cash flow from our four pillars to maximize shareholder value. Returns to shareholders through dividends, share repurchases, balance sheet strength, disciplined resource development, and opportunistic acquisitions. In 2019, Canadian Natural delivered over $2.6 billion to our shareholders through dividends and share repurchases. Approximately $1.7 billion in dividends, and we have repurchased $878 million of common shares for cancellation at the end of November. We have strengthened our balance sheet by retiring about $2.3 billion. We maintained capital discipline budget of $3.8 billion. In 2019, we're on track to deliver impressive BO production growth of 13%, or 15% per share, as we executed a significant value-add acquisition. Canadian Natural is a world-class company delivering top-tier results. In 2019, cash flow yield of approximately 14%, production growth per share of 15%, dividend growth of 12%, and year-to-date share repurchases of $878 million. These are impressive results and why Canadian Natural is unique, sustainable, robust. Let me show you how well we do versus our peers. For 2019, compared to our peers, we delivered 15% production growth per share, with only 6 of our 14 peers delivering above an average of 7. Then looking into 2020, Canadian Natural's free cash flow yield is forecasted to be approximately 15%. Only 3 of our peers have greater than the average of 7.5% free cash flow yield and greater than 7% production growth. Then adding share repurchases for the trailing 12 months, Canadian Natural has completed $1.2 billion share repurchases. Only 2 of our peers have done better than average in all 3 categories. Finally, when adding in our 10-year dividend growth, only 1 peer has done as well as Canadian Natural in delivering above average in all categories. As you have seen through this build-up of comparisons, Canadian Natural and only 1 other peer can deliver greater than 7% production growth per share, greater than a 7.5% free cash flow yield, above average share repurchases of $1.2 billion, and greater than a 10% dividend growth over the last 10 years. Canadian Natural is truly world-class, and we're delivering industry-leading free cash flow today. Let's talk further about our industry-leading free cash flow. As we look ahead to 2020, our free cash flow is forecasted to be approximately $6.5 billion, and with increased WTI pricing, it can grow significantly in 2020, and its uses are per our free cash flow allocation policy. As a reminder for some of you, our free cash flow policy is based on our 4 pillars of capital allocation strategy. Adjusted fund flows, less budgeted capital expenditures and dividends, is targeted to be allocated to the balance sheet and share repurchases on a 50-50 basis, which we look at on a forward-looking basis. Based on our 2020 capital budget, WTI of approximately $56 US per barrel, and after our current dividend today, we see approximately $4.8 billion of free cash flow. This would result in approximately $2.4 billion allocated equally to both debt and share repurchases. And with increased WTI pricing, can grow up substantially during the year. Based on our budget, our debt metrics continue to improve. Debt to book decreasing 15% to 35% on a debt to book cap. Debt to EBITDA decreasing 41% to approximately 1.6 times debt to EBITDA by year end. In summary, Canadian Natural's unique business model can deliver industry-leading free cash flow that is both sustainable and robust through all cycles. Let's talk about our capital discipline and operational excellence. As we talked earlier, Canadian Natural has a long history of taking a balanced approach as part of our 4 pillars of capital allocation. With our unique blend of assets, we can deliver a capital budget that gives production growth volumes of approximately 5% or an impressive 9% on a per share basis. And through our free cash flow allocation policy, deliver sustainable growing dividend, share repurchases, and strengthen the balance sheet. Our area knowledge, extensive operated infrastructure, and teams that they've driven to deliver top-tier effective and efficient operations gives us margin growth opportunities. Let me show you some clear examples. In Horizon Mining, where the teams have driven what's once high cost in 2013 down $22 a barrel, equivalent to $2 billion worth of margin today. Another example is our Pelican Lake, where although we've always had excellent operating costs, our teams continue to drive effective and efficient operations with margin enhancement improvement of approximately $110 million when compared to 2013. All of our teams are focused on production optimization, technology, innovation, as well as using our economies of scale to deliver margin enhancements throughout our operations. While these 2 examples are impressive, the drive to improve margin is across the company, and it's a part of our culture in both the field and the office. Here is the Horizon Oil Sands cost graph, and as can be seen, the teams have been able to find opportunities delivering ever-improving operations over the last 6 years with an impressive 50% reduction. Let's talk a little about our unique assets. For example, let me show you why Canadian Natural is so much better than our peers. Drilling a typical North American well can be great as long as you have the flexibility to be able to manage through the cycle, as when pricing is strong, a managed program can capture that value. If all you have is this type of asset, and if you cannot reduce spending through this down cycle, it has a major impact on your NPV. And when you do reduce drilling, production volumes decline quickly, operating costs escalate, free cash flow dwindles, adding to the erosion of value. This is why companies that only have this type of asset struggle or fail when there is a commodity price downturn. Canadian Natural is top tier because we have a unique blend of assets that are robust and sustainable through the cycle. Our large asset base of long life, low decline production from our oil sands and from our industry-leading Pelican Lake polymer flood supports this model. As well, reducing both conventional and unconventional drilling during this low price period has little impact on the company. Finally, volatile pricing has little impact on our NPV as we have low and predictable maintenance capital at large reserves, making our free cash flow robust and sustainable. Canadian Natural's balanced model also delivers superior growth per share in a more robust and predictable manner than our shareholders. In higher prices, more free cash flow, higher growth per share. In low commodity pricing, we can still deliver growth per share due to our low maintenance capital. Having a unique blend of low operating costs, long life production with low maintenance capital means Canadian Natural can deliver top-tier results through all the cycles. When compared to a typical unconventional well, Canadian Natural's oil sands mining is unique as there is no decline, no reservoir or reserve replacement risk. As a result, the number of wells required for an unconventional player to match our long life, no decline for oil sands production of 450,000 barrels a day is substantial and has more geological and execution risk. As well, in a year of low prices, due to short reserve life, the unconventional producers will see a substantial portion of the reserves sold at low prices. Unlike the oil sands, a small percentage of the long life reserves is produced during a low price period. Net asset value erosion per share is largely mitigated, and it has predictable maintenance capital and gives us a significant advantage over our peers. As a result of our unique asset base, Canadian Natural's corporate decline is low at approximately 10%, with approximately 62% of our production being long life, low decline, or zero decline production, requiring much less maintenance capital to maintain production. For 2020, our maintenance capital is approximately $3.7 billion, making our free cash flow more predictable and sustainable. Canadian Natural's corporate maintenance capital is top tier at roughly $6 US per barrel, 75% lower than our peer average of approximately $26 US per barrel. This gives Canadian Natural a huge advantage over our peers and supports our industry-leading free cash flow. Canadian Natural's 1P reserves are the highest among peers, showing the strength and depth of our assets, and with approximately a 24-year reserve life index, of which 84% represents long life, low decline reserves. You will see the depth and breadth of our future potential resource development in both natural gas and liquids is massive. From our lands today, we have resource potential of adding staggering 2.6 million BOEs above what we are producing today. With our large proven reserves, we can optimize our development plans, be effective and efficient, mitigate declines, target long-term growth of approximately 3%, with 55% of that potential being that could come from our long life, low decline assets. Canadian Natural has a culture of leveraging technology, innovation, continuous improvement to drive value growth. As you've seen earlier today, we have a track record of operational excellence and margin growth. Our teams are driven to continue to look for opportunities to improve the bottom line. Every gain is important. We continue to capture synergies through our economies of scale across our organization, giving us ever-improving, effective, and efficient operations. With our size, we are able to capture additional margin. In 2019, the teams have captured approximately $550 million of incremental margins through their actions. And with the culture and the drive for continuous improvement, we have more to capture. Through our continuous improvement process, our teams have many more projects in the hopper for 2020 and beyond that can add an additional $900 million to our bottom line that is not in our forecast today. Let's talk how we're ensuring returns to shareholders. Canadian Natural has a strong record of delivering returns to shareholders, and it's important to us to continue to deliver. Canadian Natural has returned $10.7 billion, or approximately $9 per share, to our shareholders over the last 5 years between 2014 to today by dividend increases and about approximately $3.1 billion through share repurchases and special distributions. This equates to Canadian Natural returning over 24% of its current market capitalization to shareholders. During the same 5+ years, our productive output has surged almost 500,000 BOEs, or 72%. Canadian Natural clearly demonstrates the ability to both economically grow the business and deliver returns to shareholders. Returns to shareholders are important to us and core to the strategy, as this history shows. We have a strong track record of 19 years dividend increases at an impressive 21% CAGR, and as a result of our disciplined allocation of capital. Our dividend growth track record is top tier for any company in any industry, as there are only 9 companies on the TSX 60 today that have been able to grow their dividend for 19 consecutive years or more. As well, Canadian Natural's dividend growth history of 21% CAGR is best in class. The strength of Canadian Natural's model is unmatched across all sectors on the TSX 60. Then compared to the global oil and gas supermajors, our record is just as impressive. Only 2 of 6 supermajors have a dividend growth history as long as Canadian Natural. Our track record history is impressive when considering we have grown the company and delivered through the commodity price cycles. Canadian Natural is a world-class company that is unique, robust, and sustainable. Canadian Natural is unique, and we are delivering sustainable growth through a blend of large resource assets. Our culture of continuous improvement drives to deliver ever-increasing margin growth across all our assets. And as a result of our effective and efficient operation, we will generate significant free cash flow in 2020. In summary, Canadian Natural has top-tier free cash flow generation and is unique, sustainable, and robust. We have a world-class track record of growing sustainable return to our shareholders, a history of capital discipline and operational excellence. We have a robust, economic, long-life, low-decline assets with the ability to grow our production and enhance our margins. Our expertise and unique assets allow us to continue to deliver with changes in market access. This will result in additional long-term value for our shareholders. Thank you, and I'll now let Darren talk to our conventional and unconventional assets.
Thank you, Tim, and good morning. As Tim mentioned, I'll take you through our high-quality conventional and unconventional assets today. I'll start with natural gas, light oil, and NGLs. One of Canadian Natural's greatest strengths is our large and diverse portfolio of assets. It delivers significant free cash flow. Our strategy for natural gas, light oil, and NGLs is proactive, disciplined, and flexible. We leverage technology and innovation and continuous improvement to grow margins, unlock production and reserves, and reduce our environmental footprint. Our strategy maximizes value through commodity price cycles and aligns with market access. Importantly, targeting $1.1 billion of 2019 operating free cash flow, where operating free cash flow is defined as field-level adjusted funds flow, excluding corporate costs, interest, taxes, and foreign exchange, less capital. Canadian Natural is the largest producer of natural gas in Canada at 1.4 BCF per day, with proved plus probable reserves 9.6 BCF. We have significant light oil and NGL production in Canada of approximately 96,000 barrels per day, with proved plus probable reserves of 665 million barrels. Our international assets provide exposure to Brent pricing, with production of approximately 49,000 barrels per day and 307 million barrels of proved plus probable reserves, all of which combined deliver a forecast 2019 operating free cash flow of $1.1 billion, reflecting the strength of our assets. Canadian Natural will continue to focus on light oil and liquids-rich natural gas drill-to-fill developments from our top-tier land base, utilizing our significant owned and controlled infrastructure. This competitive advantage has unlocked a drilling inventory of 1,700 defined locations with a production capability of approximately 340,000 barrels per day and 3.4 BCF per day, all economic at or below $50 per barrel WTI and $1.50 per GJ AECO. Economic for Canadian Natural means greater than 15% after-tax return on capital, and again, at or below $50 per barrel WTI and $1.50 per GJ AECO. A key play in our asset base is the Montney. The Montney is a top-tier light oil and natural gas liquids play. Canadian Natural is one of the largest Montney landholders in Canada and has a large inventory of defined development locations. Of the 1,700 total locations, 1,200 are premium Montney locations. For example, the Greater Wembley area, anchored by 3 large owned gas plants, has 155 sections of concentrated, de-risked Montney land with a potential for 365 light oil and liquids-rich natural gas locations, and an additional 210 locations identified in other emerging Montney layers. Canadian Natural's concentrated land base facilitates multi-well pad drilling, and combined with our relentless focus on technology, innovation, and continuous improvement, has led to lower costs and maximizes the value of our assets. One example of how we're improving costs are Wembley drilling and completions performance. We have delivered a 31% improvement in drill costs and a 17% improvement in frac costs since 2016. These cost savings have already been realized, and applying the savings to Wembley alone will deliver future savings of an estimated $300 million. As you know, Canadian Natural is focused on value creation. And through leveraging technology, innovation, and continuous improvement, I expect costs to be driven down even further. In addition to cost reductions, Canadian Natural has driven significant productivity improvements. At Wembley, in similar quality reservoir, well productivity has increased 57% since 2016 by leveraging technology, innovation, and continuous improvement. And speaking of technology, Canadian Natural is developing leading technology. Liquids enhancement and gas storage technology, formerly gas reinjection, has the potential to increase liquids recovery by greater than 50%, while preserving natural gas reserves for periods of higher prices. Essentially, we won't need to sell the gas to produce the liquids. LEGS has the potential to unlock significant value in a constrained natural gas takeaway environment and during periods of low natural gas pricing. At the Septimus LEGS pilot, I am very happy with the results of the first injection and production cycle, which indicates the recovery within the forecast range of 1.3 to 1.7 times. Because we are so encouraged with initial results, we are proceeding with the second and third cycles now, targeting another pilot in the Greater Wembley area in 2020, and a larger 25 million a day per day project in 2021. LEGS has legs and has the potential to significantly impact how we develop our liquids-rich lands. It has the potential to unlock greater than 100 million barrels of resource at very low all-in cost, both capital and operating, of $12 per barrel with an impressive recycle ratio of 5. The value of Canadian Natural's large inventory of drill-to-fill projects and LEGS technology is unlocked by our strategic infrastructure. As you can see from the map, our major facilities overlap our high-quality lands where we have substantial available plant capacity, which allows Canadian Natural to bring on production at significantly lower costs than our peers. For our international operations, we leverage our offshore expertise in Aberdeen by maximizing uptime, optimizing water floods, focusing on cost control, and capturing low-risk infill development opportunities to maximize value and generate significant free cash flow. The 2019 operating free cash flow is an impressive $580 million. In South Africa, the play has been de-risked by the 2019 exploration well, resulting in what we believe is a potential for 15 TCF E in place. As a follow-up to this significant discovery, the operators commenced a seismic program and is targeting to commence another drilling exploration well in the first half of 2020. South Africa provides Canadian Natural with a low capital exposure opportunity to participate in Big E exploration. Canadian Natural's vast, high-quality land base, significant owned and controlled infrastructure, and ability to leverage technology to improve margins and productivity unlock significant value. Canadian Natural's large inventory of defined development projects, combined with our disciplined and flexible capital allocation strategy, ensures capital is allocated to the highest return projects to maximize value. Importantly, targeting $1.1 billion of 2019 operating free cash flow. Now on to heavy oil. Canadian Natural's heavy oil strategy is to develop the assets with discipline throughout commodity price cycles and aligned with market access, while leveraging technology, innovation, and continuous improvement to maximize value and free cash flow. Operating free cash flow is forecast at $1.1 billion for 2019. Canadian Natural is the largest primary heavy oil producer in Canada at 88,000 barrels per day. At our long-life, low-decline Pelican Lake heavy oil property, the production is 60,000 barrels per day. The total combined proved plus probable reserves is 697 million barrels. Again, forecast for 2019 operating free cash flow is $1.1 billion. Canadian Natural's large, concentrated heavy oil land base, infrastructure advantage, along with efficient and effective operations, and focus on technology and innovation, provide significant value to shareholders through large, efficient drilling programs. We have 3,300 defined locations with a productive capability of approximately 270,000 barrels per day. These programs are highly flexible and will be developed with discipline. A key component of our long-life, low-decline assets is our world-class polymer flood at Pelican Lake. The Pelican Lake project is a good example of where technology development is driving significant value. We have only recovered approximately 12% of the oil in place in the developed portion of the pool, and polymer flood increases the recovery to 28%. Through operation of the polymer flood at Pelican Lake since our first pilot in 2005, we have built an in-house team of experts that lead the industry in this technology. This slide shows an example of where we converted a large portion of the field from water flood to polymer flood. After Q4 2017, there is an immediate and lasting 5 times improvement in the production decline rate. This is a clear example of where Canadian Natural's attention to detail and focus on technology has resulted in significant value growth. Additionally, Pelican Lake's long-life, low-decline reserves have high value due to low operating costs. Pelican Lake's operating costs have been reduced by 25% since 2014 through effective and efficient operations supported by economies of scale. In 2018 and 2019, we executed cost improvement projects resulting in annual savings of $33 million, which will be fully reflected in our 2020 costs. In 2020, we are targeting an additional $10 million of annual savings, and I fully expect Canadian Natural will continue to achieve similar strong cost reductions in the future. Canadian Natural's large, concentrated, undeveloped primary heavy oil land base and infrastructure advantage provides significant value through large, efficient drilling programs. CHOPS wells will remain a very important part of our drilling inventory, representing approximately half our 3,100 defined drilling locations. Canadian Natural has the technological expertise and the ability to leverage innovation and continuous improvement to unlock additional opportunities on our extensive land base. Horizontal wells now represent approximately half of our defined primary heavy oil locations. The following slides provide two examples of technology evolution and show why technology is important to Canadian Natural. Historically, in some areas, CHOPS wells have no or low productivity where the reservoir is consolidated and does not produce sand. So we look to technology for a solution. Canadian Natural we started with single leg horizontal wells, which improved inflow and were economic and only in some areas. Canadian Natural then developed horizontal wells with multiple legs that significantly improved productivity. We currently have 530 defined multilaterals, all economic at $50 per barrel WTI. One example where multilaterals have been successfully deployed is at Golden Lake. Multilaterals are 16 times more productive and capture 30 times more recovery than legacy CHOPS wells. Another adaptation of technology is fishbone horizontals. CHOPS wells in some areas have low productivity in unconsolidated reservoirs. Canadian Natural again looked to technology for a solution. Fishbone horizontal wells have significantly improved productivity and recovery. Canadian Natural has a drilling inventory of 930 fishbone horizontal wells. One example of successful fishbone horizontals is at Manitokan, where CHOPS and multilateral horizontal wells had low productivity. Fishbone horizontal wells increased productivity by 7 times and increased recovery by 5 times. This is another clear example where technology development is creating significant value. Another way we leverage our expertise, infrastructure advantage, and economies of scale is through opportunistic acquisition. As you know, Canadian Natural had made a significant acquisition in 2019. We have already captured $46 million of annual margin improvement, equivalent to approximately $6 per barrel from the conventional assets. Additionally, we have captured $17 million of one-time savings to date and are progressing projects to reduce costs by an additional $15 million. In summary, for heavy oil, long-life, low-decline assets like Pelican Lake are more tolerant to commodity price volatility due to low declines and low operating costs. Canadian Natural's primary heavy oil assets provide access to proven and emerging plays through repeatable, low-cost drilling. We will continue to leverage our expertise, economies of scale, and technology to maximize the value of these assets, driving higher return on capital and delivering significant free cash flow. Again, forecast 2019 operating free cash flow, $1.1 billion. For conventional and unconventional assets, our deep inventory of defined development projects with potential future capability of 1.2 million BOE provides Canadian Natural with the flexibility to replace production declines or grow production to maximize value through commodity price cycles and align with market access. Our extensive land base, significant infrastructure, and ability to leverage technology, combined with flexible and disciplined capital allocation, ensures the highest return projects are completed. The power of Canadian Natural's culture of continuous improvement drives incremental gains, and the power of incremental gains drives margin growth. This culture has been part of the company since day one. Targets are driven down to every team and every team member. Every engineer, every geologist, every field operator has a target to deliver the incremental gains that drive margin growth. Canadian Natural has captured approximately $260 million of annual incremental gains and margin growth in 2019, and is targeting another $190 million in 2020, which is not included in our 2020 cash flow forecast. In summary, few companies in our peer group have the quality of assets and the technical and operational expertise to deliver effective and efficient operations, and more importantly, the discipline to effectively allocate capital. It's all driven by our goal to maximize value, driving higher return on capital, and delivering significant free cash flow. Canadian Natural's conventional and unconventional assets are targeting $2.2 billion 2019 operating free cash flow. Now I will hand over to Scott for oil sands.
Thank you, Darren, and good morning. Today I'm going to talk about our thermal and mining oil sands assets. First, we will go through the thermal in situ assets. Starting with our thermal asset strategy, we are clearly focused on effective and efficient operations, in alignment with market access to capture the right timing for adding production development. We continue to find opportunities to leverage our significant infrastructure and take advantages of economies of scale. The Jackfish acquisition is a great example of that, and I will touch more on that a bit later. We strive to improve our efficiencies utilizing technology, innovation, and continuous improvement, and we have the technical expertise to deliver on those improvement opportunities. With our strong focus on continuous improvement and the strengths of our thermal assets, we are targeting to deliver $1.1 billion of operating free cash flow in 2019. This map highlights our massive thermal portfolio. We have the Clearwater, the McMurray, the Blue Sky, the Grand Rapids, as well as the Grossmont lands. One of our most significant free cash flowing assets is Primrose, targeting the Clearwater, having recovered more than 500 million barrels to date through cyclic steam stimulation, or CSS, and steam flood. The McMurray Formation has been the target for Kirby and Jackfish development, and you can see we have a massive resource. SAGD is the recovery method, and the McMurray sands are cleaner vertically compared to the Clearwater zone. Analogs and modeling show 60% or greater recovery possible, and we are piloting solvent injection to reduce the SOR of SAGD developments that will be highlighted later in the presentation. Blue Sky is another mature asset located in the Peace River area of Alberta, and we continue to leverage our expertise by enhancing our recovery process, capturing additional value. We have our Grand Rapids development at Wolf Lake, where the size of the resource could support up to 40,000 barrel per day expansion, along with future potential opportunities in Pelican Lake and Germain. The Grossmont is a massive resource, in line with the world's largest reservoirs, that requires a breakthrough in technology to unlock the value on these assets. But as you know, technology is changing very rapidly. This slide captures a snapshot of these significant opportunities on our lands with a massive amount of oil in place, over 122 billion barrels. Canadian Natural's thermal assets are vast, with over 3 billion barrels of 2P reserves and production of approximately 206,000 barrels per day. Our largest producing assets are Primrose, Jackfish, and Kirby, that have a total facility capacity of 340,000 barrels per day. We have 134,000 barrels per day of unutilized facility capacity, resulting in a significant opportunity for future growth at low cost. We are an effective and efficient operator with over 24 years of experience focused on enhancing our margins, utilizing 3 distinct thermal processes tailored to specific reservoirs: CSS, SAGD, and steam flood. These processes, combined with immense land holdings and technology enhancements such as solvents, allow Canadian Natural the ability to capture significant value. Again, these assets are targeted to deliver approximately $1.1 billion in operating free cash flow this year. One of our strengths is our significant infrastructure. An example of that is our Primrose Wolf Lake area, with over 140,000 barrels per day of facility capacity and more than 60,000 barrels per day
currently available for development opportunities. Our capital efficiency is excellent at Primrose, approximately $10,000 per barrel with average production rates of 400 barrels per day per well. We have approximately 2,000 locations identified economical at $50 US WTI and 15% or better return after tax. We forecast approximately 20% increase in recovery over CSS using steam flood and comes with very little cost because we use the existing CSS horizontal wells. We have significant opportunities at Primrose and Wolf Lake, and we will continue to focus on increasing our margins. Our large SAGD operations in Kirby and Jackfish are another great example of how we add significant value through economies of scale. We have 5 100% owned processing facilities, 3 in Jackfish and 2 in Kirby, each of which have a capacity of approximately 40,000 barrels per day. With more than 70,000 barrels per day of available capacity, our SAGD assets are another great example of our strong infrastructure capabilities. We are ramping up Kirby North production, targeting 40,000 barrels per day in 2021, and we are currently starting up approximately 21,000 barrels per day at Jackfish for only $8 million on an inventory of wells that were previously curtailed. We have significant and highly economical pad add opportunities with efficiencies of approximately $8,500 per barrel that will allow us to utilize the facility capacities for many years into the future, and with the economies of scale in these areas that will help drive lower operating costs across all the SAGD production. Our strong and unique culture of continuous improvement has resulted in significant cost reduction that will allow us to capture impressive savings of approximately $75 million per year, which is $4 billion on development opportunities going forward. This is a great example of what we are good at and one of the keys to Kirby North's strong performance. Another example where we're seeing significant cost savings is at Jackfish. We have captured an impressive $3 per barrel of operating costs, a 25% reduction since acquiring the asset. We are now targeting annual savings of $145 million on the Jackfish assets as a result of these op cost savings and other identified savings, which is $50 million more than our initial target, along with one-time savings of $25 million. Technology and innovation play a huge role on increasing the value of our assets and reducing our greenhouse gas emissions intensity. We are targeting to decrease our SOR by approximately 10% through small incremental reservoir enhancements using proven technology. We are also targeting 50% SOR improvements through solvents, which increases our potential production capability by 85% and reduces our operating costs by approximately $1 per barrel, which is $128 million in annual savings when applied to total potential production. Over the life of the asset, these savings create approximately $3.6 billion of margin improvement. Very significant by any measure, and we continue to evaluate additional emerging technologies for more margin improvement. Our long life asset base of low decline production has significant potential to unlock more value by capturing low capital costs of approximately $9,500 per barrel, delivering production increases of 135,000 barrels per day to fill our unutilized capacity. And in addition to that, 285,000 barrels per day of incremental capacity through the addition of solvents, as you saw on the previous slide, by reducing our SOR by approximately 50% and freeing up steam capacity at the existing facilities. We also have the potential to add approximately 320,000 barrels per day in future growth projects. With our economies of scale, we can continue to capture large savings through effective and efficient operations, leveraging technology. And by combining the economies of scale and leveraging those technologies, we have already captured margin growth of approximately $157 million in 2019 and targeted to capture an additional $128 million annually in future potential for a total of $285 million in annual margin growth. Canadian Natural has a competitive advantage with our large, long-life, low-decline assets. Our reserves are massive, and we have significant infrastructure to capture low capital efficiency opportunities to fill unutilized capacity of approximately 135,000 barrels per day. We have advancements in technologies that could effectively more than double that production by 275,000 barrels per day, and we have significant future growth potential of approximately 320,000 barrels per day. We have the culture and expertise to leverage our economies of scale, utilizing technologies combined with Canadian Natural's continuous improvement process to enhance value and optimize our cost. In 2019, these advantages have resulted in very significant operating free cash flow generation of $1.1 billion. Indeed, Canadian Natural is a very unique and robust thermal oil sands producer. Switching to our mining assets. Our oil sands mining strategy is to deliver maximum value through effective and efficient operations. We have high utilization and we leverage technology, innovation, and continuous improvement. We are focused on operating cost, reliability, and optimizing production, and we won't take our eye off strong safety performance. We continue to progress opportunities to increase economic production in the midterm, and we have massive long-term development opportunities that have the potential to more than double the size of Horizon and increase AOSP by 100,000 barrels per day should we choose to do so. Our teams are primarily focused on maximizing near-term value and cash flow. Our mining assets offer decades of no-decline synthetic crude oil production with no reserve risk, and we have delivered an impressive $4.9 billion of operating free cash flow in 2019. Our oil sands mining operation delivered 432,000 barrels per day in Q3. These massive assets contain more than 7 billion barrels of proved plus probable SCO reserves, making this a world-class operation with 17.5 billion barrels of oil in place. Our top-tier operating costs capture even more value with high-quality SCO barrels, with no decline and no reserve risk. We have the advantages of economies of scale with our 3 mining operations, and our teams are focused on optimizing the cost structure with strong continuous improvement, and I will show you that journey of effective and efficient operations on a forward slide. Canadian Natural clearly leads the industry in utilization. This is a key factor of our operations group, with safety and reliability at the forefront. Our teams are clearly focused on delivering high utilization through effective and efficient operations. We target to maximize capacity of all the assets, from the mines through to the upgrader. The chart shows this is one of our significant strengths. Our culture of continuous improvement is relentless. This shows the effect of reducing our operating costs by over $22 per barrel, achieving a massive $2 billion in additional margin in 2019. Some examples of how we do this are hot shift change, quick stop fuel ups, reducing major equipment downtime, reducing maintenance costs, and we put a large focus on continuous improvement projects done the Canadian Natural way to drive down cost. We are relentless at this, and we look at every area of spend, breaking it down into small incremental targets because small dollars add up to a big number. And this is how we run our business. Canadian Natural is clearly an operating cost leader, differentiating ourselves from our peers. This is another view of our strong performance, and the $2 billion of annual margin I showed you on the previous slide is also very evident in this graph, and it's one of our strengths and competitive advantages, something our teams are very proud of. You will recall Canadian Natural purchased 70% of the AOSP assets in June of 2017, which is adjacent to Horizon. We have excellent synergies that are being executed within the mines to help increase margin value and in Q3 of this year, our combined mining assets achieved a very strong operating cost of $20.05 per barrel. To drive these synergies, we have embedded the power of Canadian Natural's continuous improvement in the culture at Albion to capture the benefits of economies of scale and the assets of our underlying value of expertise. We are utilizing best practices that could not be realized prior to the acquisition on such things as the improved efficiencies of contractors and synchronizing our maintenance planning between the two sites, which is resulting in maximum production gains and reducing costs. We have stronger leverage of buying power and higher utilization of fly and fly out workers, improving efficiencies throughout the mines and the plants with a sense of urgency. One way we can grow our mining production is with our paraffinic froth production opportunity, where we have front-end capacity to increase throughput simply by adding more mining equipment. We have ore preparation and extraction units with some enhancements and the incorporation of IPEP have the capacity to outpace the upgrader by approximately 40 to 50,000 barrels per day. We estimate this opportunity will reduce our operating costs by 50 cents to $1.50 per barrel, or $55 to $165 million in margin improvement per year at Horizon. We continue to prudently advance engineering at Horizon on froth treatment opportunity, and again, we will align this with favorable market access. Another significant midterm volume adding opportunities are Stage 1B and Stage 2 Horizon Upgrader Reliability Project. We have been very thorough and diligent in quantifying the upgrader capacity opportunity, which we believe is 35,000 to 45,000 barrels per day of SCO, and will reduce Horizon's operating costs by $1 to $2 per barrel, or $110 to $220 million in margin improvement per year. We continue to perform value engineering to ensure we have analyzed every opportunity to optimize the project cost and target completion to coincide with favorable market access conditions. We are in a position to move forward with the execution if we choose to do so. We are planning the work in stages to obtain cost control. We have already kicked off Stage 1B activities, and we plan to complete that stage later in the first half of 2021. Canadian Natural has many growth opportunities, and one of the most significant developments is the next phase of oil sands mining. You can see by this slide the potential could deliver massive growth with no decline. If we choose to do so, we could add 260,000 barrels per day in Horizon 4-5, 100,000 barrels per day at Jack Pine, and 250,000 barrels per day at Pierre River, totaling 610,000 barrels per day. We will only do this development under a very disciplined capital program that is aligned with our strategy and market access conditions. Our in-pit extraction process, or IPEP, is a potential game changer for oil sands mining. We believe this opportunity has three very significant advantages. First, it reduces our overall mining costs by $2 to $3 per barrel. Second, it reduces our greenhouse gas emissions significantly with less haul trucks. Third, it eliminates the need for tailings ponds and thereby significantly reduces long-term reclamation costs. These extraction facilities will be modular components so they can be moved as we advance the mine phase. Our 500 ton per hour IPEP pilot is testing and currently underway at Horizon, and we plan to run the operation throughout next year, making modifications and improvements. Our goal of the pilot is to prove out bitumen separation, striving for equal to or better performance than our traditional extraction process, and achieve dry sand instead of tailings. We are excited with the results thus far, but we do have a year of further testing in 2020 to get it right. We are targeting to have a commercial-sized modular plant engineered design late in 2020. I will show you a brief 2-minute IPEP video at the end of my presentation. In total, with current, mid, and long-term growth, our oil sands mining assets have the potential to produce over 1.1 million barrels per day, more than 2.5 times our current production, primarily of SCO with no decline and no reserve risk for decades. Truly a world-class asset. Our strong culture of continuous improvement at Canadian Natural continues to drive margin growth. We've already captured approximately $150 million of margin growth in 2019, and with our paraffinic froth, Stage 2 reliability, and IPEP opportunities, we have identified an additional $575 million, which is not in our current cash flow estimates, for future annual margin gains for our Horizon operations. In total, there is approximately $725 million in margin growth, impressive number. These opportunities enhance our ability to add to our competitive advantage. We are in an enviable position with long life, no decline assets with mid and long-term growth potential. In 2019, Canadian Natural will deliver $4.9 billion in operating free cash flow from our oil sands mining operations. We are focused on the froth treatment and reliability capacity increases, as well as the game-changing mining and extraction process improvements such as IPEP. We are currently targeting approximately 23% additional operating cost reductions. We have the economies of scale in our 3 oil sands mines with a very high degree of expertise to focus on margin growth, utilizing technology and innovation for margin-adding projects. Okay, let's cue the IPEP video and then we'll take a 15-minute short break.
The existing process today has been around for a long time. You end up with a mega project type of infrastructure that you build, and with this scale comes also large mines moving vast amounts of material, whether it's the overburden from the top of the deposit or the ore itself, and then getting the ore from the mine, which is often kilometers away, to that central processing facility, and then taking the tailings materials, which in the existing process are fluid tailings, and then pipelining that to the dedicated disposal areas. All that adds up to a lot of material movement, and a lot of material movement adds up to a lot of energy. And so when we look at the existing process and we want to really keep up with the cost pressures that are coming in the oil industry and the environmental pressures to be more sustainable, lower greenhouse gas emitting, and progressing those goals, it became apparent we had to do something different. Refining the existing process wasn't going to get us to where we wanted to be. We really have to step change. The IPEP process was, let's think of a way that we can design a mine to move material the least possible distance. What does it look like an optimal mine plan? And then we'll build a process that fits to support that mine plan. And we said, well, this is what it needs to do. It needs to be small, it needs to be relocatable so it could keep pace with the advance of the mine. And it had to create a dry, stackable type tailings material. So not something that was pumped, but something that was conveyable and could be backfilled into the mine. As we open pit, we'll be able to close pit and reclaim in a progressive fashion.
It really helped reduce our reclamation time. So instead of it being decades, the dry tailings go back into the pit they came out of right away, and we shouldn't have to handle them again. Everyone has friends and family that look down on the oil sands. They only hear the negative things. They don't see the positive things, the amount of effort that we're putting into trying to reduce our greenhouse gases, reduce our footprint. It's really nice to work for Canadian Natural knowing that we can prove it to enough degree that they have faith in us to do this larger scale. It's exciting to be down here.
We are looking towards the next 3 to 4 years to have the first commercial 6,000 tons an hour production through an IPEP process. This process has the potential to reduce greenhouse gas emissions by 30 to 40% in the production of a barrel of bitumen. Canadian Natural has a goal of net zero GHG production. This is one step on that continuum. And so being part of a project that can actually make that kind of step change in the industry is pretty rewarding. It's pretty exciting. And very much looking forward to seeing it through to the commercial production.
Thanks, Corey. This morning I will be talking about Canadian Natural's strategy on marketing, our 2020 plan, and as Corey mentioned, our strong financial position. First, I'll provide an update on crude oil and natural gas markets, as well as outline some of the strategies employed by Canadian Natural to move our production to market. We see some positive signs in the near term to support both natural gas and crude oil pricing in Canada. On the natural gas side, supply continues to drop in Western Canada with low prices and less drilling. Although this market continues to be constrained by takeaway capacity, we see incremental egress supporting prices through Nova expansion in 2021 and new LNG facilities being built in 2025 and beyond. This is supportive for our vast natural gas asset base, where we can pace development to optimize pricing and use innovative technologies, as Darren described, such as LEGS, to maximize value. In the crude oil market, government curtailments have significantly improved heavy and light oil differentials in 2019 versus Q4 2018, helping balance supply and takeaway capacity. Market access is improving imminently, with pipeline optimizations and expansions, along with rail and Northwest Redwater Refinery, all set to increase the takeaway capacity for Canadian crude oil beginning now and into early 2020. Longer term, the full Line 3 expansion, TMX and Keystone XL will provide incremental export capacity to a diversified market, including new markets for Canadian crude oil. This is supportive for our asset base. As you've seen today, our high-quality, diversified crude oil portfolio provides significant upside. First, we'll focus on the natural gas market. A key part of our natural gas marketing strategy is to diversify our gas sales portfolio, thereby reducing our risk to exposure to one benchmark price. Canadian Natural supports construction of natural gas export infrastructure, as well as infrastructure to manage our growing liquids-rich development that was outlined by Darren earlier. We also evaluate opportunities to supply gas to new ventures in Alberta. The natural gas supply in Alberta and British Columbia continues to decrease, with lower prices and less drilling. The implementation of the temporary service protocol has reduced price volatility in the market. We expect to see a similar reduction in volatility next summer as a result of the TSP during periods of planned turnarounds on the Nova system. Significant demand growth in North America is focused in two areas: Mexican imports and new U.S. Gulf Coast LNG facilities. Western Canadian Sedimentary Basin natural gas egress capacity will grow as NGTL is adding 2 BCF a day of takeaway delivery capacity over the next few years. The LNG Canada facility in 2025 will be a further 1.9 BCF a day of egress. These incremental egress opportunities represent approximately 30% of the current Western Canada production, and Canadian Natural's massive, low-cost, liquids-rich natural gas asset base are well-positioned to capture significant value going forward. We do expect prices to be range-bound in the basin going forward, with a bias to the upside, as increase in natural gas prices are likely to be followed by incremental gas production. LNG Canada continues to move forward with its project with a startup date of 2025. Other projects continue to evaluate their economics. Advantages of Canadian LNG include low-cost feed gas and close proximity to major LNG markets. When considering North American LNG currently producing, FID'd, fully permitted, or under construction, it amounts to about 28.4 BCF a day. And when considering future targeted capacity, this amounts to 83.1 BCF per day, a substantial amount, representing over 75% on 109 BCF a day of current production, providing significant potential to unlock value in Canadian Natural lands. Again, Canadian Natural's assets and land base are very well positioned to capture these future opportunities. Our balanced portfolio has allowed Canadian Natural to capture significant value. Only 13% of our 2020 forecast production of about 1.4 BCF a day is exposed to the AECO market. The equivalent of 47% of our production is required at Horizon, Albion, and our thermal projects, and creates a natural hedge for Canadian Natural. The remaining is made up of 3% of international production and 37% of export volumes that have been successful in capturing market pricing that has been significantly greater than the domestic AECO market, resulting in over $230 million in incremental margin over the 2019 and 2020 timeframe. This demonstrates how diversity and flexibility allows Canadian Natural to maximize value on its natural gas production. Now moving to the crude oil markets. The following points are key to our crude oil marketing strategy. First, we maximize production through our curtailment optimization strategy. Canadian Natural also supports an improved nomination process that will ensure all parties are treated fairly and equitably during periods of pipeline apportionment. We also have a significant amount of storage, over 3 million barrels, that allow us to mitigate logistical bottlenecks and store crude during periods of low crude oil prices, and we maximize netbacks through optimized blending and transportation. Canadian Natural has committed and will continue to support export pipelines that diversify our markets and review economics of rail opportunities, as well as support heavy crude oil and bitumen conversion capacity, such as the Northwest Redwater Refinery. Canadian Natural's strategy and our unique, sustainable, and robust crude oil portfolio provides a competitive advantage in all commodity price environments. Beginning now, and as we move through 2020, there are significant increases to takeaway capacity out of Canada. Enbridge has completed its mainline optimization, adding 100,000 barrels a day today. Base Keystone and Express Pipelines both have projects at 50,000 barrels a day each by Q1 2020. The Northwest Refinery will be increasing throughput by an incremental 40,000 barrels a day over and above the 40,000 barrels a day of light it is processing today. An incremental rail could be as high as 220,000 barrels a day, with the government rail contracts coming onto market through 2020 for about 120,000 barrels a day, and others announcing additional 100,000 barrels a day of rail capacity. These projects add up to an incremental 460,000 barrels a day of egress capacity, of which 240,000 barrels a day is a result of pipe capacity. This volume is close to the capacity of a new major pipeline. These effective takeaway opportunities provide significant value to Canadian Natural through a more normalized and stable pricing environment. Canadian Natural is supportive of all three key pipeline expansions out of the basin. Enbridge Line 3 will add 370,000 barrels a day of capacity and is expected to be put in service in the later half of 2020, subject to the permit process in Minnesota. Keystone XL continues to move forward and is planning to start construction in 2020, and Trans Mountain has started construction and is scheduled to be in service in 2022. It is very positive that this incremental egress continues to progress and will allow Canadian Natural to capture significant value through increased free cash flow, significant future upside. This graph compares the CAP 2019 supply forecast in the black line to the takeaway capacity out of the basin. As you can see, egress now exceeds supply, providing for less volatility in Canadian crude oil pricing going forward. And in the short term, Canadian Natural will continue to maximize production during the curtailment period. At Canadian Natural, we are able to leverage the strengths of our diversified portfolio, allowing us to maximize production by increasing capacity of certain assets, others are in planned turnaround. This is a significant competitive advantage for Canadian Natural, allowing for increased value in a curtailed environment. Increased storage levels at major terminals in the basin are a major contributing factor to wider differentials, as larger storage levels reduce the options available to a producer to move its oil to market. This chart shows the decreasing storage levels once curtailment was implemented prior to the base Keystone outage on October 29, 2019, which led to a shutdown lasting until November 2019. Storage levels are a key indicator to the market and to the Alberta government on how well curtailments are working to balance the market. This graph shows that as storage levels drop, the Alberta government is more comfortable reducing curtailment as supply is less than egress capacity. The Keystone outage is reflected in the November 19 bar, but we expect this storage level to quickly decrease, given lower productive capacity due to curtailment, the Enbridge 100,000 barrels a day on stream today, and more rail and more quick access to rail. So we expect this reduction in storage to continue 2020. Crude by rail volumes have consistently increased through the last 3 quarters of 2019, 320,000 barrels a day in September. An incremental 220,000 barrels a day of rail capacity can come to market between the government volumes of 120,000 barrels a day and other announced volumes of up to 100,000 barrels a day. This is supportive for Canadian crude oil differentials in 2020 as industry rail strategies are in place and provide ample and immediate available capacity to move incremental supply out of the basin. This environment is significantly different than Q4 2018, when wide differentials justified incremental rail, but rail contracts were not in place and rail cars were not available. Additionally, the U.S. Gulf Coast is short heavy oil, and an incremental way to get Canadian crude oil to this market is by rail, providing support for continued crude by rail. Canadian Natural has not taken on a large rail position as we see incremental egress coming to fruition in 2020. The other concern is the long-term nature of the rail contracts and the netback erosion of rail versus pipe. As this table shows, the rail netback to the U.S. Gulf Coast does not compete with Hardisty netbacks into the traditional market or netbacks via pipe to the U.S. Gulf Coast. In simple terms, the cost of rail is approximately $6 U.S. per barrel more expensive than selling at Hardisty. Although rail netbacks are lower than pipeline netbacks, incremental production moved by rail can still be economic. At Canadian Natural, we continue to evaluate crude by rail opportunities, including contracts that include the special production allowance while under curtailment. Canadian Natural's sales portfolio is very well diversified, with approximately 60% of the liquids production receiving light oil prices and approximately 40% receiving heavy oil prices. Similarly, on the chart to the right, on a BOE basis, Canadian Natural's sales portfolio is diverse and balanced. This balanced product mix allows Canadian Natural to add value in many pricing environments. In summary, Canadian Natural's diversified portfolio with a number of crude grades and markets enables us to thrive in many pricing environments and provides a competitive advantage compared to our peers. On the natural gas side, we see markets improving with pipeline expansions and longer term with new LNG export facilities, and our portfolio, including liquids-rich natural gas, well positioned to unlock significant value. On the crude oil side, an additional 460,000 barrels a day of takeaway capacity starting today through 2020, and 3 targeted pipeline expansions over the next few years, adding almost 2 million barrels per day of capacity, provide significant upside via natural. Our 2020 plan and budget is disciplined and it maximizes free cash flow. Any growth capital will align with takeaway capacity, and we will balance our 4 pillars, including our free cash flow allocation policy, providing both returns to shareholders and continued balance sheet strength. Effective and efficient operations drive the free cash flow profile through prudent asset development and margin growth, as you heard from both Darren and Scott this morning. Our discipline allocation is focused on value creation. Returns to shareholders will continue, including a sustainable and growing dividend, as well as share repurchases as part of our free cash flow allocation policy. This policy includes a continued focus on balance sheet strength, which is targeted to continue to strengthen in 2020. We will be prudent and disciplined with our resource development, and opportunistic acquisitions have always been a part of our strategy. However, we have no gaps in our portfolio, and as a result, any acquisition has to make sense and add value to shareholders. Our priorities in 2020 include a disciplined capital budget focused on free cash flow generation. Our flexible capital allocation balances between conventional and unconventional opportunities and long-life, low-decline opportunities. We target to continue to improve our effective and efficient operations, drive our costs down, maximize economic returns and free cash flow, resulting in increasing returns to shareholders, further balance sheet strength. Our 2020 capital budget of $4.05 billion is targeted to deliver 5% year-over-year BOE production growth and 9% growth coming from liquids. This is an impressive targeted 9% production per share growth on a BOE basis compared to 2019 levels. These volumes assume curtailment will continue throughout the year. As a result, 2020 targeted production is 10,000 barrels a day to 25,000 barrels a day less than it would have been without the Alberta curtailment program. Natural gas declines as capital is allocated to higher crude oil assets. The strong production increase year over year is a result of a full year of production from assets acquired in 2019 and a modest but increasing drilling program as a result of curtailment no longer being applied to new conventional wells. Canadian Natural's conventional and unconventional assets deliver significant operating free cash flow, as shown. In this slide, you can also see the importance of our operating free cash flow generating international assets. Operating free cash flow from our thermal assets is growing, and you can clearly see the impact of accretive acquisitions completed in 2019 with the full benefit realized in 2020. Oil sands mining and upgrading operating free cash flow is substantial, with the graph demonstrating the consistency of the asset's ability to generate safe and reliable operating free cash flow. This chart exemplifies Canadian Natural's strengths and unique positioning compared to our peers. Leading free cash flow generation, including all corporate costs less capital, is significant in 2019 and 2020, and is a result of our unparalleled asset base that provides long life, low decline production, complemented by conventional and unconventional assets, and effective and efficient operations that result not in only significant free cash flow, but free cash flow that is sustainable year after year. Focusing on 2020 targeted free cash flow after current dividend, our allocation policy results in approximately $4.8 billion of free cash flow after dividends being allocated equally to share purchases and debt repayment. As you see here, there remains significant torque and upside to this free cash flow profile. As you've seen, our leading free cash flow profile provides significant upside for shareholders. Returns to shareholders are important to us, and we have a strong record of delivering. Canadian Natural has returned $10.7 billion, or approximately $9 per share, to our shareholders in over 5 years between 2014 to today, by way of 19 years of dividend increases and approximately $3.1 billion share repurchases, special distributions. This equates to Canadian Natural returning over 24% of its current market capitalization to shareholders. During this 5-year plus period, our productive output has surged by almost 500,000 BOEs a day, or 72%. This very clearly demonstrates our unique ability to both economically grow the business and our strong commitment to returning cash to shareholders. This chart provides for a longer period time frame and shows that Canadian Natural is leading when it comes to reliable growth in dividends, regardless of the commodity price cycle. We target sustainable dividend growth through the cycle, ensuring that the dividend remains a core element to investors. Beyond that, as opportunities have arisen, we have stepped up to bolster these dividend returns with share purchase, special distributions. Since inception, our sustainable dividend has grown at a 21% CAGR. No other Canadian E&P company and only 2 of 6 super majors have a similar track record. As you can see, with completion of major projects that are now behind us, including Horizon Phase 3 in 2017, share buybacks have increased significantly. I believe that one of the key reasons that Canadian Natural has delivered these types of results is that management and directors have more invested wealth at stake than any of our peers, and by a wide margin. We have clear alignment with our investors and a strong motivation to create long-term, sustainable value. Now I'd just like to take a few minutes and discuss the strength of our financial position. Our financing strategy includes maintaining balance sheet strength while maximizing financial flexibility. The design considers cash flows, debt maturities, and liquidity, coupled with flexibility and disciplined capital programs that target to maximize returns on capital employed. We target strong investment-grade credit ratings, which facilitate access to capital markets. Balance sheet strength is core to Canadian Natural. We believe the balance sheet is strong today, and given our defined free cash flow allocation policy, provides even greater clarity to both fixed income and equity holders to understand how the balance sheet will evolve. Our financial focus includes continuous dialogue with all three of our rating agencies to make sure they understand the uniqueness of our asset base, sustainability of our free cash flow, and our business plans, and just as importantly, our flexibility to execute or revise the plan. We also maintain a flexible capital structure that's not overly reliant on any one source of funding, with a focus on managing maturities to appropriately align with free cash flow. And as part of our robust financial position, we maintain ample liquidity to support delivering on our financial plan. We have a strong and very supportive banking group comprised of world-class Canadian, U.S., Asian, and European financial institutions. Given our strong free cash flow in 2019, we have been able to execute the following permanent debt retirements in 2019. $1 billion in public bond maturities, including $500 million in early December, and about $1.35 billion in permanent retirement of drawn bank facilities, including an additional $500 million in late November and early December that fully repays our AOSP acquisition facility. Our public debt maturity profile was purposely designed and reflects the transition to long life, low decline assets, which gives us the optionality to permanently retire or refinance debt in each and every year and remains very manageable given our free cash flow profile. As we've noted before, our free cash flow, low maintenance costs, and focus on ensuring growth is economic-based, not activity-based, our balance sheet has the opportunity to delever very quickly and is always well below any covenant restriction. In the context of our massive reserve base, we still have one of the lowest overall debt for approved net reserve, including debt added as a result of recent accretive acquisitions. In summary, our strong financial position affords us the flexibility to manage through changing market conditions and capture value-adding opportunities. We've employed a free cash flow allocation policy defined to include absolute debt repayment and returns to shareholders. Canadian Natural is in an enviable position, and we continue to deliver on our financial plan. With that, I'll turn it over to Steve for discussion on the sustainability of our business.
All right, so good morning, everyone, and thank you, Mark. As you know, one of the strengths of Canadian Natural's business model is in its long-term sustainability. As you heard from both Tim, Darren, Scott, and Mark, Canadian Natural's business model is very strong. We have great assets, our strategy is sound, and we operate with excellence and capital and cash flow discipline. We're delivering ever-increasing returns to shareholders and at the same time, strengthen the balance sheet. These same strengths in our business model apply to ESG, environmental, social, and governance, delivering industry-leading performance across the board, a significant factor in our long-term sustainability. Canadian Natural takes a long-term view on ESG, aimed at creating a long-term value. We ensure we identify, assess, quantify, and adapt to risks and opportunities. Then we align ourselves and execute. We develop quantifiable plans that address these risks and opportunities. And technology and innovation are keys to success as we continuously improve in the near, mid, and long term. I won't spend a lot of time on the actual technology today, as you've gotten a taste of how Canadian Natural leverages technology to create value earlier this morning. We also take reporting seriously, and we enhance our reporting year over year, something that will continue as we go forward. I'm going to start in reverse order with governance. We view governance as the ability to identify, quantify risks, and the ability to address long-term sustainability of the business, as well as ensuring compensation is aligned with shareholder and stakeholder interests, combined with transparent and effective disclosure of data. When it comes to governance, Canada is a top-tier performer, and Canadian Natural is a top-tier industry performer. Canada leads the world by a wide margin when it comes to governance in the top oil exporting countries in the world, with only the U.S. close to Canada. Canadian Natural also delivers top-tier governance performance, as we have a strong track record of top-tier risk assessment and mitigation, and we ensure we have sustainability across all aspects of the business and at all levels of the company. Our disclosure of financial and operational data is top tier, and management is more aligned with shareholders than any of our peers, so it's not a surprise that compensation is tied to financial, operational, and ESG performance. And we believe highly effective organizations are diverse and a meritocracy, and we've delivered on all three. We're highly effective, diverse, and a meritocracy. Canadian Natural has a strong and effective governance model. Our board, as well as our board health, safety, and environment, governance, and risk committees, review and hold management accountable to identify and mitigate risks. And the management committee, working together through various committees, identify and develop strong strategies and plans to address all risks and effectively execute those plans. This really is a part of Canadian Natural culture. Everyone is focused on delivering performance and aligned with shareholders. Canadian Natural is recognized as an industry leader in financial and operational reporting. And when it comes to ESG reporting, our report to stakeholders is aligned with the FSB and the TCFD reporting recommendations. More importantly, our ESG reporting is continuously improving, providing more information as the needs of stakeholders continues to evolve. Canadian Natural's top-tier governance performance is not surprising, considering management is more aligned with shareholders than any of our peers. We have considerable wealth at stake, and we're focused on doing it right. Part of doing it right means ensuring compensation is tied to performance across the entire company. All our employees' pay has a significant stock component, and senior management compensation is heavily weighted to performance, and with lower salaries and higher stock components compared to our peers. The magnitude of the incentive is driven by total shareholder return, and the performance is defined by environmental, including greenhouse gas intensity, operational, financial, and strategic metrics that are defined in our information circular. Incentive performance is strongly correlated to total shareholder return, notably adjusted downward at the 2015 oil price correction, and has been tracking closely, albeit at lower levels, total shareholder return, reflecting the alignment between management and shareholders. Canadian Natural is a meritocracy. To be a true meritocracy, we ensure the right culture is in place that reinforces and promotes meritocracy, and we work to improve and remove the many potential barriers to meritocracy. The strength of a company is in its talent and the skills, the people, and their ability to work together. Canadian Natural focuses on hiring top decile performers who can work together. As you know, oil and gas companies tend to be engineer-heavy and engineer-driven. Engineers have traditionally been a male career. So engineers are a good proxy for all career paths at Canadian Natural. In the case of graduates, engineers hired by Canadian Natural, we hired 54% more female engineers than the average female engineers graduating from Canadian universities. If you focus on meritocracy, by definition, diversity is the outcome. Meritocracy also applies to the board, with 33% of our independent members being female. Social responsibility revolves around society's ability to provide well-being and quality of life, provide opportunities, and a fair distribution of wealth amongst its citizens. The oil and gas sector, it revolves around our contributions to that responsibility. And when it comes to social performance, Canada clearly delivers world-leading performance, and Canadian Natural delivers industry-leading performance. Canada leads the world by a significant margin. When it comes to social performance, amongst the top oil exporting countries, with only the U.S. close to Canada. Canadian Natural also delivers top-tier performance as we ensure local and Indigenous communities participate and benefit in the near, mid, and long term from our local operations. We create thousands of jobs and lead the industry in terms of land reclamation and biodiversity. And importantly, our safety performance, top tier. Canadian Natural, through our operations, created 83,710 jobs for Canadians in 2018, and we're on track to deliver a similar number in 2019. 83,000 jobs is a significant contributor to the well-being of the communities we work in. Investing in Indigenous communities is important to Canada, and at Canadian Natural, we do more than just write checks. We work together with Indigenous communities and companies to help develop their companies and their people by providing training, business, and job opportunities. More importantly, we take the time to understand and respect the Indigenous community's perspective and their goals. We work together with 41 Indigenous communities and 188 Indigenous companies in ways that sets everyone up for success. Our business activities with Indigenous communities continues to grow. In 2018, we did $500 million of business with Indigenous companies and over $1.2 billion in the last 3 years, making a significant difference in their communities. Abandoning and reclaiming sites is an important social responsibility, and Canadian Natural has consistently led the industry in reclamation. Canadian Natural has piloted many different techniques to speed up and reduce reclamation costs. We reclaimed roughly 9,500 hectares since 2010, about the size of 10,000 football fields, Canadian football fields, and planted over 2 million trees in the oil sands mining alone. Canadian Natural abandons the most wells in Western Canada, and with our innovative area-based closure plans, we've been able to significantly ramp up our abandonment program with 2,000 wells targeted in 2019. Canadian Natural takes biodiversity seriously with robust management plans to ensure we preserve high ecological value and protect wildlife with continuous monitoring. Our reclamation plans promote diversity of native plants and return sites to equivalent capability prior to development. Horizon Lake and the work we're doing to protect caribou are just two examples of very successful outcomes. At Canadian Natural, safety is a core value. It's in every aspect of our business, from concept to execution, operations, and ultimately abandonment. We target no safety incidents and no harm to people. Canadian Natural delivers industry-leading performance with our TRIF down 52% from 2014 and 19% in 2018, and we're on track to deliver even better performance in 2019. Environmental responsibilities revolve around continually improving and delivering leading environmental performance. It's also important to understand the role of oil and natural gas in the future and develop scenario plans around the possible outcomes to ensure the strength and the viability of the company. Canada leads the world on environmental performance, and Canadian Natural, and indeed the entire Canadian oil and gas sector, has delivered game-changing environmental performance. Like social and governance performance, Canada leads the top oil exporting nations, with only the U.S. close to Canada's performance. Let me start with how Canadian Natural views the role of oil and gas in the future. So the top 6 goals of the UN's 17 Sustainable Development Goals are poverty, hunger, health, education, gender equality, and clean water. Affordable clean energy is ranked 7th and has a big impact on achieving the top 6 and our ability to actually do that, as does climate change, which is ranked 13th. There are parts of the world that collect dung, mostly women and girls, to provide the energy they need. Providing affordable oil and natural gas allows these girls to go to school and women to participate in higher value work. Affordable energy impacts gender equality. Looking at the latest IEA International Agency forecast of supply and demand, they have developed 3 scenarios. The first is a stated policy scenario, which has greenhouse gas emissions stabilizing, and the sustainable scenario has greenhouse gas emissions dropping dramatically. And the current policy scenario sees greenhouse gas emissions continue to rise. In all these cases, there is strong demand for natural gas and substantial demand for oil, with 2040 oil demand at 65 million barrels a day, sustainable scenario. Looking closer at oil demand, in the stated policy scenario, oil demand rises and then stays relatively flat, with greenhouse gas emissions staying relatively flat as well. In the sustainable model that drives a significant decrease greenhouse gas emission, oil demand is still, as I said before, 65 million barrels a day in 2040. In our scenario planning, we expect oil demand to be between the stated policies and the sustainable scenarios. We assume the current policy scenarios with oil demand increasing to 120 million barrels a day is less likely, unless carbon capture and storage and carbon capture and conversion become more widely implemented going forward, which is a possibility. Canadian oil, and particularly Canadian Natural's long life, no decline, manufacturing type oil sands will be very competitive in the downside scenario. We also believe if reducing greenhouse gas emissions is a priority, that Canada should be the supplier of choice based on our game-changing environmental performance. Now, natural gas demand looks strong, as expected, as it's the lowest greenhouse gas emission intensity fuel, and in the sustainable model, natural gas demand increases and then falls off roughly at today's levels. Natural gas is a big feedstock supplier of petrochemicals, but what many people don't realize is that about 25% of every barrel of oil produced is not used for fuel. It's used for pharmaceuticals, eyeglasses, plastics, tires, and a host of thousands of other products that are essential to our daily lives. In fact, this part of oil demand is growing the fastest. We need oil and natural gas for more than just energy. Canadian Natural views the role of natural gas in the future to grow, with the downside case flat at today's levels. We expect oil demand to be bracketed between that stated policy and the sustainable scenario, with the downside at 65 million barrels a day by 2040. That's in the sustainable scenario. For reference, the more aggressive scenarios in the December 2018 UN Intergovernmental Panel on Climate Change, or the IPCC report, that had a 1.5 degree limit, has the midpoint of oil demand at 60 million barrels a day in 2040, pretty much the same as the IEA sustainable scenario. Oil demand is still substantial. In the downside scenario, Canadian oil sands mining and upgrading projects are advantaged with long life and no decline and no reserve replacement cost and no risk. It's essentially a manufacturing operation with low total cost and, importantly, a strong likelihood that net zero greenhouse gas emissions are attainable through technology and innovation. Natural gas, in particular Canadian Natural's gas assets, are advantaged with low emissions intensity and low cost. Canadian Natural is in a very strong position going forward, even in the downside scenarios. So let me focus on what the Canadian oil and gas sector, and in particular what Canadian Natural has done to be sustainable in the future. Canada's oil and gas sector recognized the need for reducing greenhouse gas emissions, and we have been able to leverage technology and Canadian ingenuity, delivering impressive results. Canadian Natural ourselves have invested $3.4 billion in R&D since 2009, industry-leading investment. Essentially, Canada's oil and gas sector has taken what was branded as high-intensity oil in 2009 and have made it what I would call the premium oil on the global stage today. We've done it all in 10 years, and the Canadian oil and gas sector is committed to do even better in the future. For instance, at Canadian Natural's oil sands mining and upgrading operations, we reduced greenhouse gas emissions intensity by 37%. At today's production levels, that's equivalent to taking 665,000 cars off the road. In our primary heavy oil operations, through technology and continuous improvement, we've reduced our methane vent volumes by 78%. That's equivalent to taking 930,000 cars off the road. Canadian Natural also captures and sequesters the largest amount of CO2 in Canada, and we are the third largest in the world for the oil and gas sector, equivalent to taking 576,000 cars off the road. With just these three projects, Canadian Natural has taken the equivalent of over 2 million cars off the road. That's equivalent to 5% of the entire vehicles in Canada. And this is just what Canadian Natural has done alone. The entire industry has achieved similar, equally impressive results. Canadian ingenuity and our ability to innovate and leverage technology has taken what was very high-intensity oil on a wells-to-combustion basis in 2009, the far right blue bar, the levels at or below the average in green bars. An impressive Canadian success story. It's not 2009 anymore. And this is the basis or the root cause that has generated this tremendous opportunity for Canada. And the success story is just getting started. We can, with new projects, leverage technology and Canadian ingenuity to do even better, with Canadian Natural's aspirational goal of reaching net zero emissions from our oil sands operations. Net zero emissions is a lofty goal, and we plan to get there not by buying carbon offsets, but by leveraging technology and Canadian ingenuity. Canada's oil and gas sector has had a significant positive impact on our greenhouse gas intensity, and we can make a huge positive impact on global emissions as well. This is an immense opportunity for Canada. For instance, if the rest of the world achieved what Canadian oil and gas industry has in terms of just flaring, then global greenhouse gas emissions would be reduced by 23%, equivalent to taking 110 million cars off the road. And to put that in perspective, that's more than 3 times the number of vehicles on the road today in Canada. Canada is obviously leading the world. And the one LNG plant that has approved, when on stream, is equivalent to taking 40 coal-fired power plants offline, or the equivalent to reducing Canada's total greenhouse gas emissions by 10%. And we have the capacity to build at least 5 of these LNG plants, which would be equivalent to reducing Canada's total greenhouse gas emissions by 50%. 50% is a big number, and this is a big opportunity. Yes, it is true, as the naysayers will say, if we produce more oil and gas in Canada, Canada's greenhouse gas emissions will go up. What is also true, and much more important, is that global greenhouse gas emissions will go down, and they will go down significantly. In reality, not getting Canadian oil and gas on the global market will increase global greenhouse gas emissions. Taking a global perspective is a tremendous opportunity for Canada to make a huge impact, positive impact, on global climate change. Getting to net zero takes the ability to leverage technology, be innovative, and leverage Canadian ingenuity, as well as to find actions in the near, mid, and long term. Canadian Natural has a huge technology funnel with just a few of those activities listed here. For instance, at Kirby South, with solvent usage, we can drop SORs by 50% and not only dramatically reduce greenhouse gas emissions, but also water usage and costs, all while increasing production. In our primary heavy oil operations, we're piloting a process that can take our operations to a net zero state with 100% of methane emissions captured. Canadian Natural's innovative IPEP process will reduce greenhouse gas emissions in bitumen production by 40% and essentially eliminate tailings ponds, a huge win for the environment. It will also reduce operating costs by $2 to $3 a barrel, which in itself is a huge value gain. Canadian Natural is committed to leading environmental performance, and we have already delivered game-changing environmental performance. We are one of the very few companies, likely the first company that has come out and set an aspirational goal of net zero in oil sands. Canadian Natural is a performance-driven company, and we have many internal targets that we strive to meet. Today, we're sharing publicly some of the more relevant environmental goals. Our aspirational goal is net zero in the oil sands, and our interim goal is 25% reduction in greenhouse gas emissions intensity by 2025. We target reducing our methane emissions in the E&P business 20% by 2025. We'll reduce our in-situ freshwater intensity 50% and our freshwater river intensity in mining by 30%, both by 2022. Very meaningful targets that we are confident we will achieve. If you look at overall ESG performance in terms of investment priority, it's very clear that Canada should be an investment priority. We clearly lead the world. The strength of Canadian Natural's model is evident in all aspects of the company, including ESG, where we're delivering leading ESG performance. Our assets are advantaged for the downside scenarios, and we have a track record of leveraging technology, innovation, and continuous improvement to deliver ever-increasing or ever-improving environmental performance with a pathway to attaining net zero emissions in the oil sands. As a result, Canadian Natural should be an ESG investment priority. It's clear, but it's not well understood, that getting Canadian oil and gas on the global markets will reduce global greenhouse gas emissions. So if you believe action needs to be taken on climate change, then you must advocate for greater market access for Canadian oil and natural gas. It's very clear that delivering Canada's oil and natural gas to global markets should be a climate change and an economic priority for Canada. Thank you, and I'll turn it over to Tim for a few closing comments.
Thank you, Steve. In summary, as you've seen this morning, Canadian Natural has many competitive advantages compared to our peers, and we are delivering top-tier results. We have significant free cash generation for 2020 at $4.8 billion as a result of our effective and efficient operations, long life, low decline assets, which have lower maintenance requirements than a typical E&P company. For 2020, based on our $4 billion capital budget, we will grow our production 5%, an impressive 9% production per share growth. In 2019, we grew our dividend 12%, and Canadian Natural has 19 years of sustainable growing dividend with a 21% CAGR. Our free cash flow allocation policy gives shareholders clarity on how increasing returns of cash to our shareholders with both dividends and share repurchases while we continue to improve our balance sheet. Canadian Natural is built for all the cycles, unique, robust, and sustainable. Canadian Natural is more aligned with our shareholders than any of our peers, and we continue to be disciplined with our capital, a key goal of balancing our four pillars to maximize shareholder value. We have grown our dividend for 19 consecutive years, a track record we are proud of, and with our free cash flow allocation policy gives clarity on how we will continue to strengthen our balance sheet and do share repurchases in the future. For resource development, we will allocate capital in a disciplined manner across our diverse and balanced asset base for both short-term opportunities and long-term projects to grow our production with discipline. Opportunistic acquisitions have always been a part of our strategy, and we're very good at it. That being said, we have no gaps in our portfolio, and that as a result, an acquisition has to make sense and add value to our shareholders. In 2020, we will continue to be disciplined with our capital allocation. Through our free cash flow allocation policy, we are targeting $2.4 billion to our balance sheet, improving our debt to book 35%, and debt to EBITDA to 1.6 times by year end. Share repurchases are just as impressive at approximately $2.4 billion. As you've seen earlier today, Canadian Natural has the ability to deliver significant free cash flow is driven by our effective and efficient operations, a high-quality, long-life, low-decline asset base that have low maintenance capital and significant reserves that can deliver economically long-term growth. Our culture of continuous improvement is unique among our peers as our teams are focused on delivering margin growth across our asset base over and above what we see today. As we move forward to 2020 and beyond, we see the opportunities to further enhancing our effective and efficient operations. As WTI prices improve, there is even more upside for our shareholders. Canadian Natural has a proven effective strategy, and as a result, Canadian Natural is in a strong, enviable position. We are delivering in today's environment, and we will continue in the future. We are delivering industry-leading free cash flow. We have a history of capital discipline, operational excellence. We have robust, economic, long-life, low-decline assets. Relative to most of our peers, the ability to grow production, enhance our margins, and with increased market access, it will result in more long-term value for our shareholders. The key message is that we are delivering growing free cash flow that is sustainable and, most importantly, allocating capital to drive increasing returns, which are safe, robust, in a volatile price environment. That concludes our presentations today. I'll now turn it over to Corey.